We are recording today's presentation. Welcome again, and my name is Glenn Thompson. As you see on the screen, I've been working as a mentor with Pacific Trading Academy for some time, over 14 years now, between 14 and 15. You can contact us at the information you see on the screen, 800-339-8588. You have our website as well, pacifictradingacademy.com. Peter Newman is the person you may have had contact with or may speak to in the future if you're interested in finding out more about the specifics of the programs and the tutelage and instruction in various trading programs that related were what we've been doing now for 15 years or so. It's not often that I talk about trading psychology or issues related to psychology as they relate to speculation. Because we find from a marketing standpoint it doesn't sell. I'm just being straight up. Ironically, when I was starting my career at about 24, more than 30 years ago, I considered issues related to psychology and emotional states and what's going on internally as the quote-unquote fluff of the business, and how sophomoric a view that was. The interesting turn of events has been that certainly a long time ago, not too far into my career, did I realize that its intrinsic and essential nature of the issues related to what's going on in our head. I would state that the ideas and topics that relate or that we typically put under the umbrella or auspices of trading psychology are the most critical and important components to be successful in the business. And so from time to time, I do want to have a presentation where I highlight and make explicit some of the points critical and essential to being successful, to being profitable in this business, regardless of what type of investor, trader, or market participant you are. It's my view, and I don't claim that everyone holds this view. Now, having said that, let me make a distinction. A lot of times the ignorance that we have as traders, meaning whatever we're not enlightened about, whatever we don't know, whatever we can't figure out, we mistakenly just say, well, it's due to psychology. So trading psychology or emotional states and internal states, be they cognitive, cerebral, emotional, whatever, one's internal state and the variations and the pathways that can evolve through has become, I think, a convenient scapegoat, if you will, for any and all lack of understanding on the analysis side of the business. So I think that's why it seems it may have gotten or is perceived not in the highest way by some participants, especially beginning traders I've found. Again, I put myself in that category as well at one point. So that's not what I'm talking about. I want to talk about or examine the emotional states of trading, not from the vantage point of when my analysis falls short, I just lump it into and put and assign the blame on an inappropriate or an improper internal emotional state, although that might be the culprit in a real sense. But I don't want I don't want it to be a default scapegoat. Just say any and all shortcomings in our actual trading is due to a lack of inappropriate mental conditioning or a lack of psychological personal control, let's say. Clearly, and let me be very clear, and in past presentations I've made it explicit that I believe my personal kind of bigger picture way of seeing what it takes to, or conceptualizing what it takes to be successful in the process of speculation requires three, I break it up into three separate segments. Number one, the analysis, and that's what most traders of all levels and of all degrees of experience tend to focus on the most. You need some model or models or set of relationships that you utilize and depend on that creates your edge. And let me be crystal clear. Without edge, it doesn't matter the other two things, the other two components or spokes of the wheel, and one being the psychology and the other being your money management, are irrelevant. So we do need an edge. I'm not suggesting that as important as the amount of importance that I place on trading psychology, and I place the utmost importance on it by itself as a standalone, is going to get you to realizing your goals, unless you're just extremely, an outlier of statistics and a lucky trader. Clearly, if you have psychological assistance and help and counseling and whatever it takes to solidify and arrive at an appropriate internal state, that by itself, unless you're, as I said, unless you are an outlier of statistics, are not likely to be successful in the big picture of trading. What I'm suggesting is, to the extent you have built up through your analysis and research models that are going to lead you consistently to edge, that alone, without a proper emotional backdrop, is not a winning recipe. And you will, however successful you are with however good an analysis program you have and are enacting and implementing, it probably will, you'll always never realize your full potential as a trader. So they've been study after study that indicates quantitatively the importance and the big difference in performance that a proper emotional state can impute to a trader. So let's look at some of these issues, or my intent is through this set of slides and program to more or less highlight and make explicit some of these points. For those of you who are, like to see the latest trade of the week and the analysis, and clearly that's an interest to me, and I don't want to, that's not the focus of today's presentation, but at the end I have a couple of ideas that I can share with you on the analytical front, and certainly I think we'll have time to discuss in more detail the mechanics of the market. But the most important overriding mechanic, again, to just highlight today's topic, is, in my estimation, the things that are going on internally in our thought process, whether they be fueled and have their origin from a cerebral standpoint and our intellectual componentry, or kind of more of emotional, maybe from the heart. The polarity of those two origins of ideas, I guess. So let's move on. Let's progress the program and the slideshow, and then if you have questions, you can fill them in the area on the right side of your screen. If not, you can address them to me at the end of the presentation. What's psychology? It's the study of the human mind and its functions, especially those affecting behavior in a given context. So the context that we'd want to restrict our conversation to, more or less, for today's presentation, is the arena of speculation. We're all involved in this for the purpose of financial gain or some variation on that. And, that presents a special set of parameters. Financial gain, or money, I think, in a sense, is an attractor. It's a form of energy. And so the more energy makes the world go round, in a figurative way of thinking of things, I think. Trading is an enterprise. Trading, there's the analysis that we see on the left side to locate opportunities. If we have an effective analytical program, hopefully over a period of time, it will consistently, more often than not, lead us to, or we have some edge that should allow us to, often enough, whatever that is, and it will vary from one trader to another, let's say, but it should have some appropriate frequency with which it leads you to, or points out high probability situations or value areas in a market. On the psychology side, on the right side, there are two basic origins. As I just mentioned right prior to coming to this slide, you've got the cognitive, we think of our brain; emotional, we think, this has been, typically think of as the heart. So those are the two polar kind of camps, if you will, or paradigms by which ideas, thoughts, impulses, however we want to put them in, conceive of them, arise. Either and or a combination of these two, but there's this polarity of impetus, if you will, between those ideas and thoughts and feelings which arrive from the cerebral componentry, i.e. our brain, versus those that arise from our, for lack of, call it emotional, the heart, something other than, maybe an intuitive. Faulty reasoning born of intuition opposed to conscious thought. Now, you know, since the age of enlightenment, whenever that was, I've forgotten my history, but the scientific revolution, people have for many, many years placed a greater degree of emphasis on the cognitive. And I would say there's always nothing is complete. There's always there's pros and cons to everything, I think. There's always very few things in the universe that I'm aware of have a singularity attribute. There are good things and there are bad things. So we think of things, or I tend to think of things from a cost benefit. What are the pros and cons of a viewpoint, of a paradigm, of an archetype, if you will. So, but for our purposes, most frequently we find, and studies have been done to show, decisions that are impacted and directed and informed and sensitive too much to the emotional tend to be deleterious to our trading. So we got to be careful. So that's the point I'm breaking out. There's a very subtle point I want to make, maybe in a more nuanced way. I don't want to suggest that all of our emotional intuitions are wrong. I think, in fact, at the very deepest level, the problem with the emotional origin of ideas and actions is to the extent you can control, and we have an objective means of verifying the relevancy of an emotional response or activity or idea or impulse, let's say, and to generalize it as much as I can. Cognitive things that arise cognitively tend to lend themselves a little more readily to analysis. They can be studied, they can be verified, they can be understood in an objective sense much more easily than do emotional impulses. And as such, that's why, from the standpoint of the discipline of what it takes to be successful in trading, we're going to lean on or favor cognitive issues or cognitive impulses, which in turn lead to our actions, our thoughts, and in turn then our actions. So let's look at some of the biases, even regardless of their source or origin, be they cognitive or cerebral, or be they more emotional or intuitive from the heart. There can be problems with both types. So let's take a look at them and break them down. It's because if we can understand some of the problems that have the tendency and the capacity to impinge and dampen our effect, the models, our analytical models and strategies, that's the first step towards creating some mechanisms that will put them in check. To ascribe your success to skill or hard work, we call this the self-attribution, or I could call it that. To blame your failure on external factors or bad luck, well, that's convenient. And the problems that arise with either one of these things, if we don't perceive errors as errors, we can't learn from them. So that's number one. Attributing lucky outcomes to skill can lead to overconfidence. One of the interesting phenomena of the business of speculation is that, and I always tell traders that I work with in consulting and mentoring capacity, and I've worked with hundreds, if not thousands, of traders over the 14 plus years that I've been teaching with Pacific Trading. One of the things I have never ceased to be, my fascination continues to this day to be very high, is the idea that a trader, simply a person who is in a market or has established positions in markets without any understanding of what's going on, without any education, without any knowledge about the factors and forces and vectors that are responsible for the activity that they have become a part of, could and can, in fact, become very successful. They can make a lot of money. I am quick to add that in my 30 plus years in this business, I have actually seen this occur 3, if not maybe 4 times. So that can happen. The fact that it can happen is kind of, it's in the same ballpark or akin, let's say, to winning a lottery. It reminds me of the old cliche that I guess it was Ed McMahon said, somebody's going to win the lottery, but it ain't going to be you. So that can happen, though, and I think that the phenomena, the fact that traders from time to time can make very large returns, significant returns, without a commensurate degree of preparation and study and investment, let's say, of all forms, has been a major attractor to attracting members of the public, as it were, who are not formally involved with this, to the business. And then a lot of them immediately realize that if they aren't similarly experiencing that type of success very quickly, that the fortunate relatively few gamblers did, they become disenchanted. So we've got to, but nevertheless, it's a feature peculiar to this business, not solely peculiar, but somewhat peculiar to this business. Yeah, you can, by virtue of being in the right place at the right time, happen into being very successful. But I wouldn't want to, as they say, quit the day job based on that or sell the ranch. It's a very, very unpredictable phenomena, and very different from building up a cadre of tools and skills and analytical excellence so as to skew the odds in your favor. That's model development and refining your analysis. And that's what the analysis part is, an analytical part of this business is all about. Creating a model or a set of ideas so that you can consistently know in advance you have some degree of edge, so that over the long haul that edge will manifest through a distribution of outcomes. So, yeah, so one of the consequences of this self-attribution issue, which is probably it might be a combination of both cerebral or cognitive and emotional ideas or impulses, is you can overtrade. You're trading size, because if you're overconfident, you will tend to let loose and utilize all of your fodder, as it will, all of your resources, and that can quickly lead to disaster, financial bankruptcy in your business. So we will have to be careful about the self-attribution potential challenge that can arise in this. Overconfidence, a cognitive bias, clearly. An incorrect view is that a lack of confidence is holding you back as a trader versus acquiring and developing skill and learning to be confident in the skill. And this alludes to an opening remark I made. Let me reemphasize it. I was kind of glossed over it. Let me repeat this. I am not suggesting that building yourself up emotionally, whatever that means, by itself is the answer to being successful in the process, in the business of speculation or trading or investing. I am suggesting, because you could be very much edified. You could be edified to the nth degree and then some, but without a skill set that's commensurate and appropriate to interface in being an investor and locating edge, unless you're just, again, an atypical outlier of statistics, not likely you're going to generate financial return, which is a primary incentive for this business, I would think. Overconfidence leads to overtrading and an incorrect assessment of risks associated with extreme moves, both of which hurt the long-run outcomes. Here's the most important thing to remember, is to stay in the game. Once you have an edge, you can play long enough. The law of large numbers will make you rich. Don't jeopardize your future trading. I tell traders when I'm discussing money management issues, make sure any and all things you can do to adjust how you sequester your risk will have the effect of increasing the long run. So the long run is what's necessary to allow a particular distribution for your analysis to manifest. I don't know what the particular order of trades, in an array or a serial distribution of trades that I put on. I don't know the nature of that distribution, whether I'm going to have losing trades occurring first in my order of trading, or I'm going to have a set of profitable trades, or if they're going to be alternating. It's very difficult to predict in advance the particularity of your distribution of outcomes. All I can do is say, based on historical performance of my system or my analysis, it has tended over the past given amount of time and or episodes or samples, however large the sample size is, this is the distribution. X, so many of the trades worked out profitably, so many of the trades of a finite set did not work out. And I create a performance ratio, number of wins compared to the number of losses. But that performance ratio doesn't speak to the specifics as to the distribution. It doesn't, and as such, not knowing the specific of past distribution, how much more unlikely or untenable is it that I'm going to be able to project the outcome of any single outcome or trade. So it's very so this we got to be careful about being overconfident because overconfidence, again, a primary negative consequence. You can overtrade, increase your trade size to too large an amount relative to your equity, and that can diminish the possibility of surviving the long haul. And again, it's doing any and everything you can to increase the amount of time, and therefore your sample size will serve in a very numerical, tangible way to increase your odds of maximizing your dollar and cent success. Very important concept. And overconfidence is a culprit, and it's typically a cognitive, but it could also be a more kind of an intuitive or an emotional bias. Again, just because a trader may have had a series of winning trades early on, they feel that that's the only outcome that they can ever have, and accordingly adjust upward their trade size when it's not warranted. So we got to be careful about that. All right, next. The availability heuristic. If there are any questions, yeah, okay, I think we're fine, guys. All right, good. Availability heuristic. I jokingly, I have to turn the microscope on myself. I'm gonna, tendency to base decisions on the first piece of evidence that comes to mind. There are probably, I am guilty or have been guilty of this, and probably will be in the future to some extent. First piece of evidence that comes to mind, I would, at a deeper level, from possibly the emotional, or has as an emotional origin, a laziness. You hear or become aware of a concept or a set of ideas or a relationship that sounds complete, it sounds appropriate. And just because it sounds appropriate doesn't in and of itself make it the descriptor of what's going on. So we have to be careful of that. Things that just because things are become, for whatever reason or however the case may be, available to your understanding doesn't make it correct or relevant, or the relevance description of what you're trying to understand or gain greater light on or insight to or more information about. Estimation of the likelihood of events on the basis of how easy those events are to imagine. Very careful. There's no appropriate relevant correlation. Just because something comes readily to you doesn't make it correct. Doesn't not make it correct, but you can't assume that it's correct by virtue of the ease with which you come up with an idea, is to encapsulate that idea. So the availability heuristic, we've got, relevancy and correctness is not necessarily follow from ease of arrival, or ease by which you arrive or derive something. It might, but it might not. We've got to be crystal clear about that. All right, moving on. Short-term thinking, the irrational preference for short-term gains at the expense of long-term preference. This does not necessarily, take this literally, the irrational preference for short-term gains at the expense of long-term preference. Those of you who are trading premium, options traders, I don't want you to think I'm unfairly or fairly picking on you, because I know that there is, especially, this is very nuanced what I'm going to say, so read between the lines, and if you can't, don't worry, this is not too large a component of what I want to present in today's program. But, I talk to a lot of beginnings options traders, and when they have gotten to a point where they realize the game of options, and that we're selling premium, and that 80% of the time you've got scenarios where your realized volatility, that is the price, is trading at a premium to the intrinsic volatility, that is let's say where the market, or let's say the implied volatility, which is your price, is trading at a higher level or at a premium to your real, and therefore the strategy that's in mode is to sell options, and you develop short-term rental income, if you will. And you can do this on and on and on and on over the period of time. You can do it every month or at whatever regularity of frequency you like. And this has become fashionable. I'm not saying don't do that. There are times when it is appropriate to sell premium. I am just saying you got to be very careful. I'm using options because this actual concept is not specific to options. It's saying be careful under any circumstances where you have an irrational preference for any type of short-term gain at the expense of long-term performance. If you could see the bigger picture, and often dimensionality is a component that I'll talk about maybe at the end if I get a time to. Higher dimensional thinking will always give you more information than lower dimensional thinking, and I mean that in every sense, figuratively, literally, etc. But let me come back to this point. The options paradigm, or the options, the dichotomy of do I sell premium or do I buy premium? Am I long premium or am I writing premium? Is a good example to illustrate this deeper, more general concept. Very often an options trader, if they are not careful, might prefer a selling of premium trade to a purchasing of premium trade because they may look at the short, they may not look at the big picture. And often in a long premium scenario, you may sit the pathway towards the bigger the outcome, which it might be a profitable outcome, which would many times over exceed in nominal return terms, whether it's nominal or percentage return terms, the return you would generate if you were selling premium is for you give that short shrift. In other words, I'm not saying you don't if you're an options trader, I'm not saying don't not select a writing or a short option scenario or trade because of what I'm saying now. I'm saying, or don't take either one. I'm saying don't not necessarily go for a long option trade because of you're focused on the short term, where you may be in temporary drawdown, because the temporary drawdown may be far and away offset by the end result. If it is, and that would be reason to prefer or have a bias of selection preference towards being in a long option scenario to the contrast of a short trade. On the other hand, you may not. There may be a situation where selling premium is the advisable strategy. So that's just, I was picking on options traders who inappropriately might gravitate to selling premium versus long premium trades or strategies, simply thinking that that's always going to be the best strategy. Maybe not. That's all I'm saying. Okay, that's all this concept is saying more generally. Loss aversion. Oh, very emotional bias. Here's where loss aversion. This is a critical component of, and it makes a very big difference. And this is a point of separation where our business of investing, speculation, trading, whatever you want to call it, any type of attempt to attach yourself to a very complicated system such as the financial market for the pure incentive or purpose of profiting from the moves that occur by virtue of your position that you've established, has this component. The outcome, if we're successful, is capital appreciation in this business. Okay, so let's focus on this. That's our stated objective. We want to see our money, the level or the magnitude or the volume or the amount of our money increase. Well, so immediately there is this built-in, by definition, aversion to loss of money. Okay, so that creates an emotional bias. In order to consistently win over the long term, it is necessary to accept losses. What? Did I just say, did I hear what I just said? In order to make more money, I have to be completely at one with and in sync with and emotionally compatible with loss acceptance, even to the point of seeing them as no more than the cost of doing business. Well, that's a convenient way to see them. I tell people every business in this land, or any land for that matter, from A to Z, regardless of the type, you have expenditures. So what we previously call losses, our business we have two subcategories. You have extraordinary cost or expenses, and you have regular recurring overhead. Companies set up business departments, to control costs, or cost control departments. Dampen your costs as much as possible. Thus, the market maximum cuts your losses. But instead of, I tell people that I work with, and I reprogram my vernacular to instead of using the word loss, call it a business expense. The fees, commissions, etc., spreads, whatever market you're trading, whatever instrument you're trading, there are fees associated with doing the business. Those regular recurring fees can be thought of as expenses. So too can losses, or what we previously concept and what most people think of as losses. That is, reformulated. I say when you establish a position and the market moves, if the market moves out of alignment or in a manner that's going to generate a loss, call it a business expense. That's one sector. So it will tend to diminish the probability of you as creating some type of negative association, because all businesses have losses, and we implicitly factor them into the business, or they're discounted essentially. Studies show people dislike losses more than they like gains. Excuse me. This leads to get-evenitis, a condition where traders hold on to losing positions too long as they hope for them to rebound so they can exit with a scratch. Ace Greenberg's famous quote, "The definition of a good trader is a guy who takes losses." Well, implicit in Ace Greenberg's statement is, as long as those losses are appropriately small. One of my teachers, Jim Sloman, many years ago said, "Glenn, be wrong quick." One of the second most important advice I have ever received. Curiously enough, he told me the most important. Nothing matters, which means disconnect from everything. And to that extent, and I'll come back to that at the end of the slideshow today, or presentation, but the definition of a good trader is a guy who takes losses. Lots and lots of losses, the caveat or qualification being that they are proportionately small relative to your equity. And to that extent, you can make a fortune, is what I'm adding, or what anyone who understands this business, because we're in a probabilities business. Okay, confirmation bias. Once we have formed an opinion of a situation, we react differently to confirming and contradictory evidence. The nonlinearity of information interpretation, I guess, is how I can call it. Same way many standard oscillators, from a mechanical sense, when they hit the end of their scale, they're not linearly responding to any changes in the price, and that's an inherent flaw. Well, we have a similar phenomena going on internally in our emotional and cognitive processes. And it can give us bad information on the mechanical level if I'm trying to interpret the output of an oscillator, like an RSI or a stochastic, let's say, and it can do much more, wreak havoc emotionally, which in turn has raises the specter of me short-circuiting whatever edge my analysis and skills and tools have. Specifically we emphasize confirming evidence and downplay contradictory evidence. Well, there are probably some more emotional as well as cognitive. There's an interconnection here. There's our ego involved. We all want to be right. I don't know. Yeah, I want to be right in a broad sense. In a narrow sense, when I put on my trading hat, I could care less if I'm right. I do from the big picture, because to the extent I'm right, it gives me confidence from a feedback way of thinking about how effective my analysis tools are or my models are. But in the proof of the pudding point, I don't care if I'm right. I want to make money. The cliche arises, I could care less one iota if I'm right. Who cares if you're right if you're realizing your profit objectives or your equity evolution objectives? The most critical words that I ever heard Larry Williams, for those of you to drop a name, for those of you who are familiar with him, if you're not, so be it, they're still critical. More important than anything he said mechanically or anything to do with the strict market analysis, he said, chart your equity. We chart everything else if you're a technician. The whole point of doing the analysis is to have a consequence in the real world of money, so that your brokerage relationship on a regular basis is transferring money to whatever account you do, so that it can make a big difference in your life, if that's your reason for being here. They did an experiment in 2004. This is interesting. 30 men, half Republican, half conservative, half liberal or progressive, whatever you want to call them. During an MRI scan, subjects were asked to assess contradictory statements by Bush and Kerry. The brain scans showed that part of the brain associated with reasoning, the dorsolateral prefrontal cortex, was not involved when assessing the statements. The most active regions in the brain were those involved in processing emotions, conflict resolution, making judgments about moral accountability. What does this mean? It means that after a certain point, once we've made up our minds, we've made up our minds. And so what this bias is it's not good. That means that we are immune from any and all external forces or vectors that we ought to be taking into account. And that we've got to be careful. I say, you know, probably a big motivating reason for this is laziness. Or actually it's even deeper than that. I just thought it all has to do with connection or attachment. Based on, you know, ultimately attachment gives us security. If I'm attached to something, I have an anchor. I can believe in something. I've made an investment. Now let's put it to work. I need to get a return on my investment. You know what? Markets don't know anything about your investment. However extensive, large, you know, whatever sweat equity, dollar and cent equity, however much time you sweated, or how many books you read, markets are impervious and unaware completely to any of the above. More to the point, if a market could comprehend anything in the world external to it, it could care less. Markets flow. They move by definition. So we got to be very careful about this, checking ourselves that there's never enough information. Granted, you know, and even our objective part of our minds might come in and say, you know, this is a good thing. No, and it might proffer up the rational thought, you know, too much information could analysis paralysis, and we will never get anything done. No, it's better, and it might also, as a supporting argument, this thought might present to run across your mental screen. It might say that most of the information you come across is noise, and why clutter up? Why introduce further noise when we're trying to reduce or increase the signal to noise ratio? We want to clarify and only take and reduce the amount of bad information relative to the good information. That's true, but how do you know? How does one know in advance what information is relevant versus not? So to the extent you reach a point where you feel you know you cannot be told anything new is inherently dangerous, especially in this business. And it's put under the confirmation bias. Watch out. Hindsight bias. Once an event has occurred, we tend to think that the event was predictable. A single realized outcome is far easier for us to grasp than the multitude of possible outcomes that did not occur. This leads us to overestimate the accuracy of our predictions as we retroactively fit them to data. This also goes by the name of I knew it all along effect. An obvious danger of this phenomenon is that very often leads to overtrading, trading too big or too large a trade size. This is I think this is probably a evolutionary biological survival mechanism. That's how I think it came about. Regardless of how it came about, it's inherently dangerous. So we have to be careful about this. Let me back up before I go to this slide. It probably has to do, you know, with our mental capacity. It's a consequence or a ramification of our. We all are wired differently. We all have certain capacities to retain, comprehend a particular degree of vastness of information. Some can interpret and receive more information, others less. So a single event or single situation is easier to grasp than a multitude of possible outcomes. So we grasp that which we can, but doesn't make it right is what this particular bias that can in a negative way impact our trading is basically about. So we have to be on guard about concerning that as well. Making the jump, this is critical. And this is really getting to where I think your emotional state and the emotional makeup is critical, because it is really a critical juncture in the process of being successful as a speculator. I was talking to someone on a conference call a few nights ago. He was a former student, and we had conferenced in and to see how he was doing. And in the course of the conversation, it came out, I don't know if he's actually listening today, Tien, but in any case, he made a comment. He said, I wish someone would do a presentation or write a book or speak to what are markets really about? The deeper level. What is the, really explore what a market is about, and in turn, as a logical consequence, the process of speculation at levels that are not purely superficial. I could easily do and have done presentations on Elliott wave, on Gann analysis, on trend lines, on trend analysis, on oscillators, on candlesticks. There is a gamut. There is a plethora. There's no end to the number of factors and components and building blocks, if you will, of the analysis side of this business. That does not describe trading or markets. It describes a paltry sum of the things I've just mentioned, of tools that human traders or entities, because right now in the world of 2015, we have algorithms, we have artificial intelligence entities that are placing orders. Ultimately, it was a human consciousness. Curiously, as a side note, I won't spend too much. I just saw an article, was it a day or two ago, Stephen Hawking said that in 100 years, the state of artificial intelligence will have surpassed human consciousness. So I want to generalize this on that continuum, whether one buys into that or not is not for discussion now. I'm just threw that out there. We have programs right now. We have coded programs that place orders, and to some extent understand, and not just in trading, in all fields. You got what was it? Big Blue, that the chess playing program. But in any case, here's an important component. At some point, I don't care if you call or designate or think of yourself or conceive of yourself as the most automatic or systems trader, at some point you have the potential to interrupt or pull the plug or interrupt a signal that is derived from an automatic system, however automatic it is. You don't have to respond. You can selectively, unless you can pull the plug on the system, on the hardware that's initiating or sending the trades to the arena, to the exchange. Ultimately, there is the potential for a given level, however small it might be, of discretion. So there's always this give and take between degree of discretion versus automation of activity. But here's the point I want to make, and this is critical. Whatever analysis on the left side, fundamental, technical, quantitative, think about at some point, a sales job has to be done. There has to be a marketing of the outcome of that analysis to the entity that's has control and the right of refusal, or you can put it through or not allow it to go through. You can veto the entirety of the outcome if you choose to, or you can agree and stamp it and send the bill through. And this arrow right here, what occurs in that gap, in that breach between derived output of analysis versus and what that impact and how that impacts your internal state and the corresponding response is the most critical component of this business we call trading or investing. Think about the number of times you have looked at a price chart and said to yourself, it looks like the market's going to go one way or another, and what you thought was going to happen actually happened. However, you did nothing except watch the market move while you anguished over all the money you could have made. It's happened many, many times in my career. It happened yesterday. Well, it didn't happen yesterday. I saw the situation and I saw leading up to a signal, and then I left my office for an hour, came back out a signal. But I have many times seen a signal, see all of my criteria that I have predetermined are appropriate for me to pull the trigger and establish a position. And because I, for whatever reason, did not impact that output of analysis, whatever information, I did not sell myself convincingly enough to translate an internal idea, thought, whatever, impulse into a corresponding real-world action. Oh, that's purely mental. Has nothing to do with any oscillator or any form of analysis. The analysis did its job, and that's all it's required to do is give you an output. buy this market, sell this market, put it in order at such and such a price, place a stop, put it on a hedge. That's what the analysis's job objective is. That's its job description. If it does it, it spits out information, its work is over. But that doesn't make you, I know a lot of great analysts who haven't spun a dime. They'll make money and give it back based on what occurs in this region here between where the end point of the analysis, the gap, this region here, you've got to sell it to what's going on internally. Otherwise, if you don't sell it convincingly enough, that analysis will lay dormant. Sometimes your mind will tell you it's a good thing it lay dormant because the outcome might not have agreed with what the market did. And as such, you would have a consequence of a financial, what we previously called losses, what I refer to now from the previous slide as a business expenditure. But remember, loss aversion to things that are inevitable, what type of insanity is that? Business expenses, if I don't incur business expenses, what gives me the temerity to think I can run a business? So translate to our business. If I don't incur losses, what gives me the right to think, what gall do I have to think I get the privilege of experiencing the open-ended financial return? I've got to have losses. They are part and parcel of this process. So that, that might be a reason that your mental apparatus as a safeguard, ancestrally and through in order to provide our biological sustenance of the species, we support our ego. We got to stay on good terms with our ego. We offer that up as an excuse as to why we didn't follow through. But this what takes place in this part of the stride where this arrow, that transit, you can derail that train very often. And this is what's critical. This is why trading psychology is so essential. It has nothing to do with this side of the picture, the analysis. It has nothing really to do with what's over here. It's how effective, what's going on in this process in here, and your state internally is what it determines whether this train makes it from the starting station to its destination. Because if so, that will allow this to realize the edge that it has, assuming it has an edge. Otherwise, if it doesn't make this transit, if that trip is short-circuited somehow because of an inappropriate internal state, good luck with that. That's the point. That is the framework by which we must evaluate our internal state. How to make the jump. In order to make the jump, you must identify the characteristic that separates the consistent winners from everyone else. Here it is. Winners have attained a mindset, a unique set of attitudes that allows them to remain disciplined, focused, above all, confident in spite of the adverse conditions. Therefore, they are no longer susceptible to the common fears and trading errors that plague others. All right. The obstacle. Emotional pain. Make sure I read it. All right. Either you guys are, okay, good. Emotional pain and financial disaster are common among traders because trading is full of paradoxes and contradictions. You know what, there are all sorts of definitions for what a paradox is. Here's one of them. I didn't come up with this. I might have heard it somewhere or read it somewhere. It's things that don't make sense to us because we are on a given dimension. And I bring it out to dimensionality. If I'm on two dimensions and I see a phenomena that doesn't make sense, on one hand, I should read, if I follow through and interpret it one way, it would lead me to one conclusion, but simultaneously it gives me the possibility of reaching an altogether opposite conclusion at the same time. That's a contradiction. Why is that? How can that exist? I am not sufficiently dimensionally, there's not a dimensional parity. I'm not on the same dimension with which that phenomenon may be playing out. I'm on a lower dimension. Same analogy I offered up recently in sports. If you're watching a sporting event, if you're up in the stands from high up, you get to see and interpret information more fully. There's more comprehensive a picture that you are privy to than the participant on a two-dimensional. You being in the stands are privy to everything that the two-dimensional players on the floor or on the field are seeing, but they are not privy to the higher up. They're not seeing what they're doing from the vantage point of a higher. They're outside of it. They're in a third dimension, let's say. Whereas they're You're in the third dimension if you're viewing from up above or down below. They're on the two-dimensional plane. And as such, there's less information, and as such, there are going to be paradoxes. And there are going to be tripping ups and problems and contradictions. That's the obstacle. That's a major obstacle in this process. All right. Contradiction. Unsuccessful traders are obsessed with market analysis. This is very interesting. Let me repeat that. Unsuccessful traders are obsessed with market analysis. You know, successful traders are too. Let me comment on that. I don't want you to just think I came up with these ideas because they sound good. It's true. Unsuccessful traders often are, probably more so than successful traders, have to a greater extent in a side-by-side comparison. Because why would an unsuccessful trader be obsessed with market analysis? Because it's one thing they can be successful at. If I can't be successful in the discipline that I solely am interested in, that is trading, and its corresponding dollar and cent metric, then let me at least, by way of carrying on and living with myself day to day, so that ultimately I can live with myself, be successful at something. And a component of the broader concept or endeavor of trading is analysis, but it's a component. I would say that successful traders are also obsessed with market analysis, but not to the point where they don't allow for an equal obsession with the other components, i.e., what we're talking about right now, and capital allocation or money management. Unsuccessful traders just feel it's based on a lack of modular development or something that's missing in their system. I know because I felt that way for many years. They crave the sense of certainty that analysis appears to give them. Well, yes, it does. Let me repeat that, or a portion of that, or rephrase it, paraphrase it. Analysis does, when it's done correctly, give you confidence that you're on the right track. It confirms in a very intimate feedback way you have it correctly. Let me repeat that. Good analysis gives you confidence that you're doing the right thing, and as such you may begin to think you can be profitable. That second, the last part of the sentence may not be incorrect, but is not certainly a truism. Just because I have good analysis doesn't by itself guarantee my success. I could have the best analysis in the world, but go back to this slide. This is the analysis and its product. I got to sell it to my thinking, to my internal state. The best analysis in the world will fall flat on its face without a corresponding sales job. Be crystal clear on that. And how do you affect that marketing campaign? You have to understand analysis alone is inappropriate. They crave the sense of certainty. Yes, it does give you certainty. It's okay, but certainty unsold will die. A vestige of that, you can write a book about it. Great analysis. Unsuccessful traders attempt to create certainty where it just doesn't exist. What a thought. Ironically, once the fact that certainty doesn't exist is accepted, an alternate certainty is derived. That is, the absolute certainty that certainty doesn't exist. In this business, there may be some other things for which certainty does exist in this world, in your daily life. You know, I will say this, even though I know it's not true, but to make the point, I would say it's 99.9999, just add, almost an infinite number of number nines to the right of a decimal point, that tomorrow the sun will rise in the east and set in the west. In a figurative sense, the world turns on its axis in the particular direction that it does. We have that phenomena. Ever since I have, since for billions of years, that's the way it's been, let's just say. It's not, I don't think it's perfectly certain, because at some point that may not be the case. But I would bet to the degree that I just did numerically, say that that's certain. So certainty does exist, not in our business. And so we have to make this disconnect. The moment we realize that we are dealing in an endeavor and in an activity that is inherently uncertain is the moment that we begin to adjust our internal state to be readily acceptable to ideas that our analysis are selling to it. You must do that. The answer to learn and think and this is the solution to the emotional, to the rescaffolding, if you will, the reconfiguring of our internal state. We must think in probabilities. What does this mean? Trading is inherently risky. In other words, no trade has a guaranteed outcome. You got to live in that. You must immerse that must be permeating that concept. Therefore, the possibility of losing money is always present. Naturally, someone might consider themselves to be a risk taker in this environment. Okay? That's the issue. This is a problem. This is the way the playing field of our business is structured by definition. It is a probabilistic enterprise, meaning there are no certainties. The whole point of your model, your analysis, is to enable you to work those odds in your favor, so that more often than not, if you have a robust enough methodology, you're able to skew the odds in your favor. The best traders not only take the risk, they have learned to accept and fully embrace that risk. That means they are, let's think about that, a consequence of that. If I fully embrace risk and I incur a business expenditure, what we normally all colloquially think of as a loss, I'm not upset. So I am aghast when I talk to traders and they experienced a losing trade and there's some degree of frustration. I understand it, but it tells me implicitly right off the bat, that trader, or in my own trade, I'll make myself the target of this phenomenon. To the extent I am in a position and I liquidate that trade and my equity there's been a decrease of an expenditure, I ought not be moved one way or the other. If there is any angst or frustration or disappointment, that is the fact that there is disappointment tells me I have not inherently and completely and internally immersed myself and understood that this is a probability business. Because if I completely understood that any outcome is completely uncertain, I always tell people every time I initiate a position in a market, I recognize explicitly there are 360 possible degrees or possible outcomes, some of which are profitable, some of which are not profitable, and there are varying magnitudes or degrees of profit or loss or expenditure. To whatever degree a trader has not accepted the risk is the same degree to which he or she will avoid the risk. Let me repeat that. To whatever degree a trader has not accepted the risk is the same degree to which that trader will avoid the risk. Why would you, how hypocritical, I don't know what the word is, how inappropriate relative to what we've just stated. This is a risk business. We deal and live and are immersed and intertwined with risk. If risk is omniscient and omnipresent, why would I be avoiding something that I can't avoid? Trying to avoid something that is unavoidable will have catastrophic effects on your ability to trade successfully. It'll also create mental trauma. It'll traumatize us emotionally as a side product, as if loss of funds is not sufficiently counterproductive to what this business is supposed to do. Trying to avoid something that is unavoidable. It's kind of like one of those market maxims or cliches of being insane. Trying to avoid the unavoidable. You're on a downward spiral if that's what you're trying to do. And it is a direct indication or reflection of the idea that you have not accepted or have not begun to think of everything you do and think in this business as in terms of probabilities. You must in order to be successful. Steps in probability thinking. Anything can happen. So that's in light of what I just said a minute ago. Every time you get into a trade, realize there are 360 different possible outcomes, the whole spectrum. You don't need to know what is going to happen next in order to make money. What a concept. What an audacious, absurd idea. I don't need to know. So now, there's a subtle point here. I hear traders, who focus to it's like nutrition. When I was growing up, my mother, at some point you hear too much of anything, too much of the best, too much medicine can kill you, too much water can kill you. Overbalance or underbalance or getting out of balance is what this concept is saying. So what I was trying to bring out about this concept is I don't need to know what's going on to happen next. Well, that's true, but okay, in order not to take that too far to an extreme, doesn't mean that I purposely utilize this concept as license not to, as much as I can, fine tune my edge analysis. No, I got to be very careful here. I'm not presenting this as steps in probability thinking as a step so as to indicate that you should not, or purposely in an overt proactive way, not incorporate as much edge as you can. You want to. But forecasting, I've heard traders say you don't need to forecast, or I don't need to predict the market to make money. Well, that's true, but I think a little bit of prediction can, to the extent it incorporates or improves your edge, is going to only help. It can't hurt unless it, by itself. So we got to be careful not to go in one area to an extreme so that the opposite effect occurs. There is a random distribution between wins and losses for any given set of variables that define an edge. Yes. An edge is nothing more than an indication of a higher probability of one thing happening over another. Every moment in the market is unique. I must have Mark Douglas, who has written over the years extensively about how to properly condition and shape your internal and construct your internal state. How to embrace risk. Distinguish the micro from the macro. From the macro, a particular pattern may have a certain edge. Okay, as an example, there are price patterns, there are candlestick formations that may have a certain frequency of correlated with a certain subsequent price action. Okay, 70% of the time, a double bottom suggests a market's going to stop trending down and reverse to the upside. 30% of the time, it means it's not going to work. Why is that? Why is it not a perfect certainty of correlation? Because of the micro. At any moment, underlying market structure is different. There could be an infinite number of ways by which a double bottom, a macro particular phenomena, let's say, I'm using a double bottom chart formation, a classical chart pattern, as an example of something that we, in a macro sense, all understand if we understand what that's about. A particular classical chart pattern correlates to certain types of price activity. If you understand that relationship, on the one hand, you should further understand that it is a macro phenomena. It's something that we can understand in our heads. However, it's also critical. Why does it not work perfectly? Because there are an infinite number of ways by which or how this macro relationship can manifest and occur. Not all of them are going to evidence the 70% of the time, let's just say, of positive correlation. There will be some of the internal micro ways by which a macro phenomena can occur or bubble up to the macro surface so that it is discernible to you and me, such that it doesn't correlate with the outcome we would have hoped for or projected. So understanding and differentiating the macro from the micro is essential to enabling us to understand risk and to embrace risk. This is why no particular pattern works all the time. Cognizance of the above will keep you from discriminating edges. Very important. All right. The final answer, detachment. You must be completely detached from any and all financial outcomes. Jim Sloman taught me this. He stated it even more raw or purer terms, or more, concisely. But this is the ultimate answer to anything going on internally that can hurt you or dampen or impede your progress in financial speculation. If you don't believe it, just take it from me. I mean, you don't have to believe it. It's the case. This is the most important. I tell people, if whether they accept it or resonate to it or not, it doesn't matter. The most important thing to being successful, if you define success in the process of investing or trading in dollars and cents terms, I talk to traders all the time. Another wonderful aspect about this business is that there are many calling cards that it presents. Some people get in it for the action and excitement, and I accept that, and I think that's a great thing. It's not why I'm here. I sometimes can get excited and find it fascinating or thrilling, but that's not my primary attractor, if you will. I am saying, and it's a very specific statement, if someone is in this business primarily for the financial returns and remuneration, the most important thing you can ever do is what this is follow through on the message in front of you that you see right now. You must be completely detached from any and all financial outcomes. However absurd you might find that on the surface or not, it's irrelevant. It is imperative. However difficult it is to achieve that state, it's irrelevant. You must. To the extent you have any hope, unless you are just, again, you could be a statistical example. But barring that, and yes, this business does have that. There are some traders who, by virtue of simply being in the right place at the right time, can make a fortune. Again, to give that context, in 35 years in this business, I have seen that happen at most 4 times. 35 years, think of all the millions of traders worldwide in our entire existence and all of the activity. Now, it has happened more than that. I'm just saying, I'm citing my own singular. But as a percentage, yes, we are recording this for your question. I'm glad you asked that question. I just wanted to make sure you guys are still there. I'm almost over. But this is the final answer. Moving on. Trend trade. This is this is from an old slide. I should have deleted this. This is just to show, this is a trend line, merely to point out a form of analysis. It's an analysis, okay? I might be thinking, to the extent that there is a tendency, as I teach in trend trading, I always start from the premise, whatever it is that a market's is doing or is going to do, it's most likely a continuation or a persistency of what it's been doing. From an analytical standpoint, that's the most important thing I know. However important it is, it's less important than this. Because if I know what this slide teaches me from trend analysis, even let's assume that I understand trend analysis from A to Z. I've taken courses. I understand everything there is to know about trend analysis. And I realize and come to, and explicitly on paper or in a computer database somewhere, understand all the output. If I don't have this, a detachment, I can't sell it and I won't pull the trigger. Or the computer program may not present the order to the market, and I may very well watch a trade that would have generated a decent return pass me by. It has happened many times to me. It will continue. It's happened to every trader, and it will continue to happen. The problem is I don't have enough detachment, because with complete detachment, I am not selecting outcomes. I don't even need the marketing campaign or the sales job. I without thought, accept whatever the output of my analysis, whatever my analytical presents to me, whatever derived information is presented, it's a smooth sail. It's what do they call it, a warm call versus a cold call? If I have this detachment, the final answer, I don't need to be sold. I automatically, like an automaton, take the answer and run with it. Some of those outcomes will generate business expenditures. Some of them, if I've done my appropriate testing and back testing on my model, it will, and it has historically proven to lead me to edge. I've got edge. Then I let the law of large numbers do its work for me. Okay, that's trend analysis, and versus the opposite paradigm of analysis. And being a trend follower that the previous slide indicated, and the opposite, completely polar camp of analysis, anticipating. Most traders love to anticipate. We want to be able to claim I sold the top or I bought the bottom. My area of research, market timing. I don't even know what this is. Cotton. It was an old slide, and I had a time target back a couple of years ago. And moving into that, the significance of this analytically was when it reaches the time point of balance between price and time, it should change. Well, that's analysis. If I am attached to something, I may or may not enact or act on that, and I could miss an opportunity. If I continue to not respond to the output of my analysis because I am attached to certain outcomes, I will continue to derail however good my analysis is, regardless of its intrinsic power or robustness. Okay, that's just okay, is lack of confidence holding you back versus is lack of edge checking your confidence? Very often it's I don't have sufficient skills and tools and foundation of understanding for which I should have a modulated amount of confidence, not over, not under. And so very often it's not this. I'm saying the trader that has built up their analysis tool set should have an appropriate amount of confidence. Make sure also, just for that segment of traders out there, I am not saying that building up your confidence and codifying an appropriate internal state without the other components, that is building up your models so that you have a paradigm of edge, and coupled with that is money management. It's like a triangle. There are three components that create the triangular configuration for what is essential. All of them are important. If anyone is lacking, you're at deficit, and you're short-circuiting your odds. Okay. Psychology, the scientific study of the human mind and its functions, especially those affecting behavior in a given context. I had this slide at the beginning, so we're come full circle so that I can present the future. A new perspective of trading psychology. These are just some what I consider a little more provocative thoughts concerning the passive emotional state adjustment versus a more active emotional state incorporation. Measurement versus direction paradigm. Analysis, and I want to present this idea. If you accept this and see my point, great. If you don't, it's not for you. For whatever, and it's not bad. It's not right or wrong. It's just not for you at this time, let's say. This is just a more provocative thought that I presented about a year ago. I want to revisit it because I believe in it. And so there's this hypothetical discussion between a so-called student and a teacher. Student asks the question to the teacher, in a way, I suppose, but I use my voice as a ruler, measuring the words of my teachers without my intuition, or excuse me, with my intuition or some related faculty. So intuition, the student is saying, hey, I'm monitoring and trying to learn and accept and understand and interpret via two outlets, my emotional intuition, my heart, or some related faculty, i.e., let me fill in the blank there, my brain. Brain versus, mental versus emotional. The two major ways or mediums or tools that we as human beings at least utilize to interpret the world external to us and information that emanates from that world. Now, here's a last thought that he presents to his teacher. I don't originate the thought or idea. I simply evaluate it. Evaluation is analysis. Origination, that's something different. That's the point I want to. Origination is in the realm of creation. Two different things. Curiously enough, our internal state handles both of these activities. Evaluation, which is it's a type of measurement or interpretation facility. Origination really has a different ballpark, creation. Here's the teacher's response. And why do you do this? I want you to catch the teacher's view on the student's view of how they accept and internalize and resonate with information that they are picking up on and perceiving and receiving. Why do you do this? And there's nothing necessarily implied by the teacher's response. He's just asking, why do you do this? I think the teacher may be provocative or wanting to provoke the student to wonder, why is it? What questions have they asked to determine that the measurement process is superior or more appropriate than the creation process? Why do you assign yourself? And here he makes it a clear distinction: a diminished role of measuring versus analyzing, of measuring and analyzing instead of creating an invention. Again, folks, if this is not something you agree with or resonate to, that's fine. I'm not trying. This is just my view. Example of measurement paradigm. And this is just the same paragraph, this slide and then the next slide present essentially the same information, but with two flip-flopped or opposing spins of interpretation or presentation. A basic premise of technical analysis is that all information one needs, or all is that all the information one needs is contained in the price. That's true. That's a theoretical foundational premise of TA, technical analysis. By extension, each and every day, and in fact, each and every moment, a market's price is composed of a time and a price component. I believe that. That's a GAN idea. That's a little more nuanced technical. That's not strictly speaking TA, but it's an extension of a TA. Some traders believe that. In other words, the space-time, or more specifically price-time continuum of energy, is what we are observing when we view a price chart. If and when this energy, which represents the market, moves by a certain specific amount of price/time, it reaches an equilibrium point of balance. Because by definition a balance point is so sensitive, it marks or corresponds to a point of change or a turning point. Think about turning points. We see them all the time if you look at charts to help formulate your views and your trading and your trades and your strategies. Tops and bottoms. Most traders, they're ubiquitous. Most traders are immersed and constantly thinking about tops and bottoms. I'm not saying that's right. I'm not saying it's wrong. I'm saying it is, myself included. I am constantly thinking about tops and bottoms. Whether I attach a large amount of significance to a top or a bottom or a little is a separate, albeit important question, but that's not the point of this slide. Because by definition a balance point is so sensitive, it marks or corresponds to a point of change or a turning point. Essentially, tops and bottoms are points of resonance that allow energy to come in and overflow the system so that it changes. That is, or stated in a more colloquial sense, a market stops trending up and reverses and comes down, or a market stops going down and reverses to the up. A reversal in price change has been affected. Now, this is an idea that I believe in, and you don't have to agree with it or not, but it's merely a recounting, a redacting, and an echoing of some. It's just an indication of my assessment, my measurement of some of the components and the processes that take place causing market action. It may be right, it may be wrong. It's a theoretical opinion I have. But what the point I want to make is it's measurement. I am doing what the previous slide, if I can go back there, said. I am playing the diminished role as the teacher, if I were to have a teacher that I think more deeply comprehended from a broader dimension or a higher dimension. I am operating in the analysis segment of my internal state. I'm evaluating, and I've reached a certain consensus or opinion on what it is that's responsible for market motion, and that's based on my evaluation. Versus, okay, so that's the measurement paradigm, versus an active or proactive or an aggressive psychological paradigm, a creation or an invention paradigm, using that same mental apparatus, but taking the same information but reconstituting the paragraph or paragraphs. A basic premise of psychological and or behavioral speculation is that all market motion, past, present, and future, originates and is informed by energy which emanates from the speculator. Very different. Remember what the previous a basic premise of technical analysis is that all information one needs is contained in the price. So the price is the originator of information from the measurement paradigm, and I, as the external observer, am taking notes. I'm trying to figure it out via my tool set, what I've learned given, whatever grade of school I've achieved, or whatever acumen level I have come to, whatever level on my analytical totem pole of understanding it has been at that point, versus utilizing that internal state in a completely opposite way. Instead of spending my time on pure analysis, trying to explicitly deconstruct or reverse engineer what the price is giving me, why not redirect the energy, a basic premise, and say that the price action, the energy, comes from my thoughts. By extension, each and every day, and in fact each and every moment, a market's price is composed of a time and price component. That's true. That's essentially the same. By extension, each and every day, and in fact each and every moment, a market's price is composed of a Tyson. That's essentially remains constant. That is invariable regardless of your internal mental or emotional or cognitive paradigm that you're operating with. Okay. In other words, The space-time, or more specifically price-time continuum of energy, is what we are creating when we interact with a market and its chart. This is pivotal. This is the liaison of change here. That's not. In other words, this space-time, or more specifically price-time continuum of energy, is what we are observing. That's active. I'm operating emotionally and cognitively and internally on a lesser ladder, a lower rung of the ladder, so to speak, because I'm in measurement paradigm versus I am actively shaping. In other words, that is what we are creating when we interact with a market and its chart. Just think of it this way. To the extent, now, you in your account, given whatever size account of or amount of equity you have, the amount of equity to the extent determines indirectly or directly your trade size. More money means you can indirectly or directly affect a larger trade size. At some point of funding or financing or capital available, you could theoretically have such a large trade size that you begin, in a tangible sense, to move the market. Moving the market is creating or being the force or vector responsible for the thing, the entity, we call it a market, of which you're a part of, and its chart. If and when this energy which represents the market is moved or manipulated in a specific manner through certain amounts of price time, it reaches an equilibrium point of balance. But again, notice from this alternate paradigm of you, the individual participant, affecting the output. When this energy is, which represents the market, is adjusted, moved, manipulated in a specific way through certain amounts of price time, it reaches an equilibrium point of balance, because by definition a balance point is so sensitive it corresponds to or marks a point of change. In other words, the market turns. When the collective energy reaching the market achieves a sufficient degree of resonance, sufficient to create an energy overflow, the market changes course. But ultimately, what is stated in this paradigm on this slide is completely opposite, very different set of parameters and events than what was presented on the preceding slide. Same information manipulated opposite ways. Mirror images, two sides of the same coin. So I just submit that as a mental manipulation. The universe responds to your directives. You know, I'll forego. This is just commentary on the last slide. I mentioned this a year ago, and someone took offense because they thought I was too aggressively presenting my views. It's just a view of the creation, whether you abide by it or not. It doesn't have to work. I'm just saying it is a view by which you can create market behavior as opposed to interpreting market behavior. So let me forego that. Final set of slides. Euro USD. This is the euro just in terms of analysis. Immediately I see this chart, I see analysis, I see structure, I see information. This is just a simple oscillator, simple price action daily. This is a spot currency pair, the Euro USD, because I know we are so focused on analysis. While I'm here, because I got two more slides. If there are any questions while we wrap up. This is, obvious from a wave standpoint, 1, 2, 3. We may see a little move into lower prices here in the euro relative to the dollar. And as corresponding strength in the dollar for the next week or so, which would enable a completion of a correction fourth wave, which in turn would allow for the euro to resume going up. That's everything I just said to highlight to the extent, that's just a quick cursory overview of a daily chart of a set of markets comparing the euro currency with the US dollar. And we had a buy signal here by virtue of what I know. We had another buy here. Whatever the case is, whatever I might or you might interpret by looking at this chart, to the extent you don't have the degree of attachment that enables you to have an appropriate internal state so you can non-selectively seize and apply and act on the information that your interpretation, whether your interpretation agrees totally with what I just said of the euro versus the USD, or it is somewhat similar, or if it's the antipathy, if it's the exact polar opposite. If you sell the euro and buy the dollar today, which is the opposite of what I was suggesting, or the same, it doesn't matter. To the extent you don't have the degree of detachment that enables you to think completely in probabilistic terms. so that you are not fighting with any particular outcome. Regardless of the outcome, you are in sync with it. You know, it's kind of like what Einstein said, what would the world look like if you were riding piggyback on a photon? Think about that, because it requires the light is what's reflected. If you look, you know, if you were, what would the world look like if you were riding on a photon, an individual unit of light, and you were aimed at a mirror? What would you see? I don't know. I'm just saying, what is essential is this is the analysis. It's going to give you based whatever edge it gives you, assuming it has edge. And if you don't have an edge, work on your analysis through research and system development until you do. Not so difficult. That's ironically, when traders are beginning, myself included, we think that's the most difficult part. It's kind of analogous to when you're learning to read. You learn an alphabet, or you let a learn of basic building blocks. Typically, that tends to be the most tedious, labor-intensive time at the time. But when you have passed through and moved past those formative stages, you realize in retrospect how simplistic that was relative to the potential compositional potentialities that exist for that language or that skill or the basic building blocks. So what is initially the most daunting to build your foundation of tools, your toolbox, ultimately becomes, you know, an afterthought, assuming you have gotten to that point where you have edge. All right. So this is just one example, just so we have something to think about. This is just another dollar versus the yen. I will probably be going long the dollar relative to the yen very shortly based on what I see here. That may be your view. It may not be your view. There are a lot of events on every level of information, and the whole construct and paradigms of model and registering indicators are set up to help us make sense. That's the analysis. However much sense you make of it or how little sense you make of it, keep this in mind. The market is not discreetly and explicitly aware of any amount of sense you come to, or any amount of understanding or clarification you have arrived at or derived of its mechanisms, of its current state, much less its historical state, and much less its extrapolated future state. A market could, if it could marvel at how astute you are, or how non-astute you are, or how ignorant you are, or how prescient you are, it could care less. The market, if anything, would probably be, can't even marvel at the fact that you marvel at that. Markets just flow. By definition, that's what they do, as best as I can understand. So our job is to make sure through proper adjustments, and again, the key component is being detached. I haven't said anything about how you do that. I don't know. There is no one way. You do whatever is necessary. For people I work with, we go through exercises that I have read about, that I've learned, that others have taught me, and that I've dreamed up. That's not difficult to get on board that track of progressively greater and greater and greater degrees of detachment. It is the most important critical thing if you want to be, as measured in terms of dollars and cents, profitable and obviously profitable, that goes without saying, synonymous, successful in this business, as measured by a financial ruler, so to speak. The final slide. This is just ostensibly from a capital flow standpoint, one of the most important, and I'm not a fundamentalist, I always say, but you want to understand financial markets or money, look at the bond market, because it's an inverse relation. It's talking to you in an indirect way about money flow. When bonds go down, it's because good things are happening in the world. When bonds go up, it's because things that, in a common sense, very rudimentary, very basic, very sophomoric way of seeing the world. But you start with the simple and progressively work to the greater and greater degrees of complexity. So, what's the bond market doing now? I'm short, and I anticipate further declines. For the last week or so, we've been going up. We came back down today. There's always going to be complexity. We utilize and depend on and hinge on and make our decisions based on our analysis. The point of this presentation is, even if you did not, let's say if we are not interested in proactively creation utilizing our internal state to inform and create and direct market behavior, if we don't choose that directed control and application of our trading psychology apparatus, if only you choose to measure in a way so that it's not an impedance to your analysis, but rather a co-worker in that process of what it takes to skew the odds as consistently as possible, we still want to have ultimate degrees of detachment. So whatever I might conclude for where I think the cost of money and where investments, the cost of money determines all investments, what the stock market's going to do, what the currency markets are going to do, what oil does, in a sense. Oil's very close because that's almost on its own, because that's strategically the most important, but it's a form of money in a sense. So this chart essentially in a graph, in a very macro way, kind of highlights that analytically. However much it tells me, I still must ensure that I have a properly fashioned internal state. And the way to do it is detachment. Final slide. I always tend to, as a matter of practice, present my most recent projections in time. Again, timing is my area of research. From a cause and effect standpoint, I believe it is the most important component to determining price activity. That's a minority view, I know. These dates are past dates, and these are future dates for the stock market. Stock indices here in the United States, they indicate nothing about direction of trend, merely points of change, i.e. trend reversals, to provide a simplification. The last one we had that I think was important, April 26th. Next one happens to be Memorial Day. So when you project a time, or when I project a time target that happens to land on a point in time that the market's not trading, you look at the surrounding dates. So you figure roughly the last week of this month, I expect change in the stock market. Given the trend of the last few days, I would expect or assume it's most likely going to correspond to a market top, but time will tell. Any questions, folks, in the remaining time? And when I sign off in a minute or two, if there are no questions, I will do so sooner rather than later. If there are, we have a few minutes, and I'm happy to address the questions you may have. Let's see. Oh, thank you for the compliments, folks. If you have any questions, certainly. And it's hard, again, within an hour and 15 or 20-minute presentation to get into any one of these to the extent that I'd like. But again, we offer the 50% discount where you get to trade. I think it's a month mentorship for, well, this is a 50% discount. Maybe that's for the entire mentorship. Yeah, that probably is. I know last time, a week or two ago, we offered a discount where you get a free mentorship, but it's just the 1 month. Our normal mentorship is 3 months, so maybe they're offering the 50%. Again, I don't know this is just what came attached. They transferred to my file to attach to the end of the slide presentation. Peter Newman is the person that can answer any specifics on any of our programs, and happy to do so. So if you want to if you're interested in our programs or querying me more specifically on this issue, trading psychology and emotional issues that relate to this, you would need to talk to Peter, and he can sometimes set that up. I'm happy to talk to traders when I have the time to do so. Let's see if there are any other questions. Thank you for the compliment on the books. Yeah, some of the stuff, just by way, I didn't mention it. I was tacit, so I tell this to get I say what I'm about to say to get your attention, but it's very true. If you ever come across what you think is a really good idea, say an indicator or a market relationship, keep it to yourself, because because of the observer effect, we are, if it's very precise, and when I say that, meaning numerical, probably to the extent you expose it is the extent to which its ultimate, over time, its performance will trail off. That phenomena doesn't happen in other areas, for example, as much as it does to the extent in the business of speculation. It is very user sensitive, or this business is user sensitive in terms of ideas that impact it. Now, having said that, I had a dilemma years ago when I started teaching, and I asked one of my teachers, I asked a few of them, Jim Sloman, Michael Jenkins, Larry Pizzavento, Jeannie Long. I said, to what extent, when I teach students, am I hurting my own capacity? Because to the extent ideas that I feel are really central and can make a difference and to provide analytically edge to a trader, I'm giving up some of my trade secrets, so to speak. Here, the unified response was, it's a numerical thing, as a percentage. So few, mediocrity rules the day. Like in, not just in this business, but in every realm. We find it's not good or bad. It is the way the world is. I have found this to be the case. We have that normal distribution. Most kids, you have a few kids at the top of the class, a few at the bottom of the class. Most things in life, people kind of gravitate to that normal bell curve average. So what I'm saying is, if you really have something that you feel makes a difference and you've tested it, probably you should keep it to yourself, and at the end of your days, bequeath it to your people who you leave behind, your beneficiaries, write the book, etc. Yes, I have been approached to write. I have written many newsletters over the years. I've worked for research firms. I have not written a formal book. I could. Here's the interesting twist. The things that I come up with that I think are worthy of publication probably are, for the same reason I just mentioned. Some things you keep to yourself is what I want to say. That is not to say that there aren't things that you can teach and present to a broader community that are worthwhile and valuable and substantially impactful. The quick answer is I'm just pressed for time. There are only 24 hours in a day between my trading, teaching, and other things that I do. I have not, but I do have a certain standard that I want to make sure to, and I have been approached to write books and by various entities over the years, and the standards that they have talked about have not, it's my name at the end of the day that I want to put on it. So that's part of the reason, but I may very well publish more in the future. So it's not as if I won't. I will. I just don't know exactly what and when and so forth. But thank you for the compliment. You have to get the link to hear the recorded, contact the toll-free number 800-339-8588. Just make a request. If you get the secretary or whoever you get, or if you get the voicemail, leave a message. The computer department handles the links that you need to access this recording, as well as any and all of our archived recordings that I have done, webinars, and my coworkers over the years. We've been doing the webinars now for, I think myself, about 2 years or more, maybe 2.5 years now. It's been a while. You'd have to, for now, the email address, you can just probably contact the toll-free number or our website and ask for Peter Newman, and any contact with me, if we do further than that, he can arrange that. So I appreciate the interest, though. Let's see if there's any other. I think that's it, folks. Well, it's been a pleasure, and I hope you got something out of it, and I certainly always enjoy presenting ideas that I have that I think are going to be helpful, because they help me as well. So again, I don't want to ever do a presentation that I think is substandard. Some of them have, I think, better than others, as they go, but I want to continue to present ideas and new ideas and maybe new spins on old ideas that are going to be ultimately, in a tangible sense, helpful to you. So until the next time, I wish you a great day and profitable trading in the days and weeks to come until we meet again. Have a great one. Bye-bye for now.